Good morning, everyone. This is Tara Sewell, internal wholesaler with Financial Markets. Thank you for joining us today. Your lines are muted for sound quality. If you have questions, please reach out to your internal wholesaler today. And we will be drawing for one winner for our March Madness giveaway. Our winner will have a choice of a smart TV or a locking gun safe. Neil Sperling, Vice President of Financial Markets, will be showing us some hidden gems of the Secure Act 2.0. Thank you for your business. Together, we protect families and their financial futures and their legacies. Congratulations to Steve. He was the winner of our $500 Amazon Christmas shopping spree. And congratulations to our runners up. Let's dive into the details for our March Madness Spring giveaway. You received one ticket for every application submitted from January 3rd through March 17th. You earned double tickets for applications with our premier carriers and triple tickets if the case was placed by March 17th. And today, the odds are in your favor. We have 3,677 tickets in our hat. Your name can only be drawn once, and you must be pre-registered and present for the duration of the call in order to win. Before we get to the drawing, Financial Markets Vice President Neil Sperling will be sharing some opportunities of the Secure Act 2.0.
All right. Well, good luck to all of those with tickets in the drawing today. And most importantly, thank you to each producer on the call. If not for you, we would not exist. We're continually honored to be your brokerage of choice for everything annuity, life insurance, and related products in your portfolio. Today, we're going to look at some interesting gems found in Secure 2.0 Act. So let's get started. The original Secure Act was part of the fiscal year 2020 spending bill passed by Congress and was signed into law by President Trump. Your elected officials decided to call it the Secure Act, standing for Setting Every Community Up for Retirement Enhancement. Pretty clever wording if you ask me. Now, just a few years later, we get the Secure 2.0 Act. The $1.7 trillion Consolidated Appropriations Act of 2023, more commonly known as the Omnibus Spending Bill, included the Secure 2.0 Act. After passing through both chambers of Congress, it was sent to President Biden, where it was signed into law December 29th of 22. There are a great deal of new provisions and changes in the Secure 2.0 Act in which benefit retirees. In total, there are 93 primary provisions in the legislation. Having this sign into law on the second to last business day of the year, with many of its provisions becoming effective January 1st of 23, it was a real scramble at the beginning of the year for institutions and compliance departments to be sure they were in alignment with the new rules and regulations. The document you see on your screen is a publication from the National Association of Plan Advisors. It summarizes all 93 provisions found in the Act, and you're welcome to request a copy from your internal wholesaler here at Financial Markets. In the short time we have together, we'll address some of the more impactful provisions that may be beneficial for your practice. Let's start off looking at one of the cool hidden gems in the legislation, the changes to QLAC. Before we dig into the details, what is a QLAC? A qualified longevity annuity contract, basically an immediate annuity funded with qualified money with a payment start date no earlier than 1 year from purchase and no later than the taxpayer's age 85. The most basic benefit of a QLAC is that for those tax qualified funds allocated to a QLAC, they are not subject to annual required minimum distribution rules. This allows taxpayers to defer taking income from those monies to as late as their age 85. The taxpayer can have the income begin anytime 1 year or more after moving the funds into a QLAC, and they cannot delay the income start date any later than age 85. Another use for a QLAC would be for someone with mostly sufficient retirement assets with longevity as their primary retirement risk. Those persons can take a portion of their qualified monies and put it in a vehicle that will provide guaranteed lifetime income in their later years. while their primary retirement assets may have been depleted by that time, but for whatever intended use, QLACs have been around since 2014, and adoption has been slow because of the complicated rules. Prior to Secure 2.0, in order to place monies in a QLAC, it was limited to the lesser of 25% of qualified account holdings, or 145,000. While the prior formula is not that complicated, it prevented many from placing a meaningful amount of assets into this type of vehicle. With Secure 2.0, the 25% limitation was removed and the amount raised to 200,000, which will be indexed for inflation starting in 2024. The $200,000 limit is a one-time lifetime limit, but this opened the door for nearly everyone with qualified monies. There's no minimum age when a person can transfer money to a QLAC. They just must begin taking income by their age 85. So let's look at the three carriers that we currently offer that offer a deferred income annuity that complies with the QLAC provisions. Here we have American General, Forethought, and Lincoln. All three carriers rated A by AM Best and all pay the same compensation, a single amount of 4% of the client's premium. Keep in mind that rates change all the time. Your internal wholesaler here at Financial Markets can compare these on a case-by-case basis for you. The example here is using a male, current age 75, placing the maximum 200,000 lifetime limit into a QLAC this year and deferring the income to year 2033 or his age 85. You can see the income ranges from $3,400 per month all the way up to $4,095. That $4,095 per month represents an annual cash flow of more than 24% as compared to the original premium amount. So not only is this a great tool to delay taking RMDs from a portion of one's qualified monies, it provides a nice opportunity for longevity planning and retirement. A 24% cash flow created in just 10 years in this example. Now, what happens if the client dies before age 85? In that case, the named beneficiary would receive the $200,000 back without interest. So what if the client had already began receiving income and passes away? In this case, the named beneficiary would receive a lump sum equal to the $200,000 minus any payments already received by the original now deceased account holder. But wait, what if the client lives too long? Because this is a lifetime income annuity, payments continue as long as the annuitant lives. If they make it to age 95, they receive nearly $500,000. And again, the income will continue as long as there's a heartbeat in the annuitant. Please keep in mind, this product is not only available for qualified monies, it also accepts non-qualified monies with no IRS limitations, possibly a tool you might consider using in longevity planning. Moving along, a little walk through the history of after-tax qualified money, most commonly known as Roth. Appropriately named, the Roth IRA was born as a result of Senator William Roth's proposal, which was added to the Taxpayer Relief Act of 1997 and became effective in 1998. This new tax status allowed persons to place after-tax money in an account where growth and ultimately distributions would be allowed to be taken income tax-free. To say the least, it's been a very popular retirement planning tool. Later, the opportunity was expanded to include 401ks and 403bs by the Economic Growth and Tax Relief Reconciliation Act that was signed into law in 2001, though the ability to use Roth 401 and 403b was not effective until the Pension Protection Act of 2006. Now 17 years later comes a new version of Roth funds, the simple and SEP Roth plans. While 401ks have had and do have high allowable contribution limits, the SEP IRA is somewhat the granddaddy of all qualified funds, where in 2023, it allows up to the lesser of 25% of compensation or $66,000. But don't get too excited yet. While Secure 2.0 does provide for SEP and simple Roth IRAs, the IRS has not provided complete guidance on establishing and funding these with after-tax monies. But certainly when the dust settles, having SEP levels of contribution limits on a Roth basis, I think will be interesting. Moving on to RMDs. This is a hometown favorite for everyone in their 70s. There are some significant and potentially confusing changes found in the Secure 2.0 as it relates to RMDs. Just to provide a quick background, a required minimum distribution, or RMD, is an amount of money that must be withdrawn annually from an employer-sponsored retirement plan, traditional IRA, SEP, or simple IRA by owners and qualified retirement plan participants beginning at a specified age. The required start date now has changed twice in the past 3 years. Here is a chart published by the IRA expert Ed Slott. This is about the easiest chart I've come across to clarify the changes. So basically, if you're already taking RMDs as of 2022 or earlier, nothing changes for you. You'll continue to take RMDs as you've been doing. Then there are those in the donut hole, those persons with a birth date of July 1st of 49 through December 31st of 1950. You're the beneficiary of the changes found in the original Secure Act, allowing you to defer your RMDs to the tax year in which you turned age 72. For everyone else, born 1951 or later, you'll find changes. Of that group, for those born from 1951 through 1959, the start date is now the tax year in which you turn age 73. For younger savers born in 1960 or later, they will get to defer until age 75 before their first RMD is required. One thing to note is the Secure 2.0 Act was just signed into law in late December and effective January 1st. Many financial institutions, including some of our insurance companies, sent fair market value letters to IRA owners early in January, which was not yet updated with the new RMD rules. On March 7th, the IRS kindly issued a public notice allowing those institutions to send corrected notices by April 28th of 23 if prior notices were incorrectly sent. Expect your clients to begin receiving those updated notices. Now here's a common topic. I forgot to take my RMD. Now what do I do? Prior to Secure 2.0, this was a relatively uncertain topic. Basically, if an account owner did not take RMDs as required, they were subject to a 50% tax penalty, and the 50% tax penalty was based on the full amount of the missed RMD. Fortunately, or possibly unfortunately, the Secure 2.0 Act has made some significant changes to this rule. Now, if the RMD is not taken as required, the penalty is only 25%. And further, if the RMD is missed and later taken to remedy within 2 years, the penalty is only 10%. Wow, that sounds pretty good, right? Many of those who missed the distributions paid the penalty as prescribed in the IRS rules, but a little known fact was that with a good excuse, the 50% tax penalty was waived in nearly all cases where the taxpayer submitted a special IRS form asking for relief. Even the IRS itself thought the 50% was a little steep for a retiree making this common mistake. So along comes a brilliant idea. Let's lower the penalty. So again, the penalty prior to Secure 2.0 was 50%. How much did these taxpayers normally pay in penalty? Zero. Now, certainly some paid the 50% penalty, but most sought advice from a professional and found the option to ask for relief, and the relief was granted in nearly all cases. So now what is the penalty with Secure 2.0? Most taxpayers subject to RMD discover their error within a year or two of their RMD start date. So instead of 0%, the penalty will be 10% for most taxpayers moving forward. It was a really brilliant way to increase taxes by lowering the rate that was never charged to a rate that even the IRS could stomach taking from a retiree. So be careful moving forward to advise your clients to pay attention to those RMD notices. And I'd also stress, have your clients establish automatic annual RMDs so they do not have to request them each and every year. Set it and forget it. Moving on, the standard deduction was first adopted in 1944 and it was equal to 10% of adjusted gross income up to a maximum of $1,000. And like nearly everything else, it has changed. What's the purpose of the standard deduction? It's consistent with a progressive tax code where the lowest income earners would not have to pay taxes on the first certain amount of monies earned in a tax year. Second, to save the IRS from having to receive itemized deductions for small expenses relative to income such as mortgage, interest, and charitable giving. As you can see, there was a significant jump in the standard deduction in 2018. It went from $12,700 for a married couple all the way up to $24,000, meaning a couple paid 0% income tax on the first $24,000 of income in 2018. While some were itemizing in 2017, the new higher standard deduction in 2018 reduced the opportunity for itemized filing. In tax year 2017, 46.2 million households itemized their deductions. In 28%, that dropped all the way down to 16.7 million, which represented a 64% drop. While this change was good for many, it did make the incentive of small charitable contributions less attractive. So keeping in mind the standard deduction, let's look at another hidden gem. While there are some minor changes with the QCD, the Qualified Charitable Distribution, this has been available since 2006. The QCD, though, was not that popular until the standard deduction was increased to such high levels in 2018, as we reviewed on the prior slide. So how does the QCD play a role in tax efficiency in light of the current standard deduction levels? First, the earliest one can take advantage of this IRS provision is age 70 and a half. The money must be transferred directly from the financial institution to the charity, and the charity must be a valid 501c3 organization. Essentially, it's a tool allowing an individual to transfer qualified money to a charity without having taxable income from the distribution. So let's take a look at why this is so effective today. In this example, we're going to use a 75 male, a single filer, which holds a $100,000 IRA. This taxpayer is charitable and has sufficient income for his lifestyle. He's required to take RMDs from his IRA while he doesn't need the income. As a charitable person, he decides to give the RMD to charity. The normal path to do this would be to receive the RMD, which at age 75 for $100,000 comes out to $4,065. He gets the RMD and turns around and gives a tax-deductible donation to charity for the same amount. When he files his taxes, he soon realizes that while the donation was in fact tax-deductible, it is effectively not deductible because his standard deduction far outweighs his charitable giving, essentially eliminating the benefit of the tax-deductible donation. How would he benefit from doing the same, but by using the QCD? He still needs to take his RMD for that year. However, he completes a special form for the financial institution to have his RMD made directly payable to the charity he selected. Then, rather than getting a taxable 1099 at the end of the year for the distribution, he still receives a 1099 showing the total distribution of $4,065, but it shows $0 as taxable. In this example, he saved 22% of the $4,065, which is $894. What a cool way to help save a few dollars on taxes and give to charity. Now, keep in mind, this is not limited to RMDs. A taxpayer can use the QCD provision to donate up to $100,000 per year. In a married filing jointly case, that's $100,000 per person. While again, this provision is not new, the Secure 2.0 Act provides the minimum amount will be indexed for inflation starting in 2024. I'd say that's a pretty cool hidden gem. The Secure 2.0 Act is an interesting set of provisions that are mostly beneficial with some hidden gems for both the U.S. Treasury and U.S. taxpayers. Good luck to all of those with tickets in the drawing today, and most importantly, thank you to each and every producer on the call. With that, I will turn it back over to Tara Sewell.
Thank you, Neil. And if you would like a copy of the Secure 2.0 Act summary that was published by the National Association of Plan Advisors, please reach out to your internal wholesaler. We also look forward to helping you with your next case. Now let's get started and draw for our first finalist. My hat has been shuffling this morning, and we'll drop those names into the hat, and we are looking for our first finalist. Jim Marotic with 23 tickets in the hat. Is Jim on the call, Neil?
Checking the list here. And Jim is not on the list, Tara.
All right, let's draw again. We're looking for our first finalist, Brian Waits with 65 tickets. Is Brian on the call?
Brian is not on the call.
Okay, we are going to keep drawing until we get a finalist here. Andrew McCollum with 14 tickets. Is Andrew on the call?
Andrew is on the call.
All right, congratulations, Andrew. You should have received your hard copy of the FMI Pathfinder in January. I hope you find this a useful tool. The FMI Pathfinder displays all products available to you through financial markets, as well as case studies, underwriting insights, concepts, and communication and sales ideas. As you work toward your production goals for 2023, you can increase your sales in the business market with some ideas found on page 12. Another sales idea on family succession planning for farmers and ranchers is found on page 50. And as you review the product pages, you will discover a great summary of each of the product types. Here's just a short listing of our IULs. Additional resources for business planning and family succession is found on our website, fmiAgent.com, under Agent Tools, Advanced Marketing Resources. Then check out the resources on the Virtual Sales Assistant and the Turnkey Sales Kits. On to our next drawing. We first have Andrew McCollum. He is our first finalist. We are looking for our second. Kirby Bowden with 222 tickets in the hat. Is Kirby on the call?
And Kirby is on the call.
Congratulations, Kirby. You are our second finalist. We are going to draw our third. Thomas Alstrom with 52 tickets. Is Thomas on the call?
Taking a look here, Tara. And Thomas is on the call.
Congratulations, Thomas. You are our third finalist. In our drawing for the Smart TV or the Locking Gun Safe. Now, you can subscribe to the Financial Markets YouTube channel at youtube.com/FMIAgent. You will find webinar replays, sales concepts, case studies, consumer videos, and Dow's Weekly Digest with our very own Ed Bartling. You can also catch this season's Sunnier, Warmer Day. Let's draw our fourth finalists for the Smart TV or the Gun Safe. Just to review, we have Andrew McCollum, Kirby Bowden, and Thomas Alstrom. And our fourth finalist, Connie Benson with 6 tickets. Is Connie on the call?
Taking a look here. And Connie is not on the call.
Okay, we are still looking for our fourth finalist. Lisa Ware with 240 tickets. Is Lisa on the call?
Taking a look here. And Lisa Ware is on the call.
Congratulations, Lisa. You are our fourth finalist. And let's go ahead and draw for our fifth finalist. Chelsea Slavin, 15 tickets in the hat. Is Chelsea on today's call?
Let me take a look here. And Chelsea is on the call.
Congratulations, Chelsea. You are our fifth finalist. So just to recap, we have 5 finalists today: Andrew McCollum, Kirby Bowden, Thomas Alstrom, Lisa Ware, and Chelsea Slavin. Going to move my hat here and put together our drawing.
And folks, we look forward to hosting you for the 2023 FMI Agent Point Awards trip. The location will yet be announced, but for as little as $30,000 of life insurance premium or $1 million of annuity premium or any combination thereof, you and a guest can join us on our 2023 FMI Agent Point Awards trip. Very attainable, and we've gone to some excellent locations, and this will be just as good as the previous locations. We look forward to serving you this year as you earn points towards the 2023 FMI Agent Point Awards.
We have our 5 finalists: Andrew McCollum, Kirby Bowden, Thomas Alstrom, Lisa Ware, and Chelsea Slavin. Just going to shake these up here a little bit and drop them back in our hat. And let's see who our winner is today. Kirby Bowden, congratulations. You won the drawing, and we will be contacting you for your choice of a smart TV or a locking gun safe. And congratulations to our 4 runners-up on winning the $50 Amazon gift card. Now, summer is around the corner, and so is our next promotion. The grand prize for our summer giveaway is your choice of a Blackstone griddle or a propane fire pit table. Our runners-up will receive a Made in the USA custom solid maple cutting board. Thank you for your time today, and thank you for your partnership and for your loyalty. We'll see you next time. Have a beautiful day.